Welcome to this tutorial on partnerships. Now, we learned in earlier chapters that a partnership is not a person. So it is not going to be subject to income tax. So a partnership does not file an income tax return. So then how is the income in a partnership going to be taxed? Well, all the income that's earned in a partnership will be allocated to each partner. And that's going to be based on the terms set out in the partnership agreement. So every partnership will have the partnership agreement, and that's going to determine how much income will be allocated at the end of every year to each partner. Now, in terms of the different types of income, most partnerships will have business income. And partnerships will also prepare their own financial statements under generally accepted accounting principles. So usually when a partnership prepares their financial statements, they're going to have their income statement. And so they're going to have their net income for accounting purposes. Now, when they determine how much of that income will be allocated to each partner, they actually have to reconcile that accounting income to net business income for tax purposes. Now, this reconciliation is similar to what we learned in earlier chapters. In chapter 6, where we talked about business income, and when we talked about corporate business income in chapter 12, we had to do that reconciliation. We took the accounting net income, we made some adjustments. For example, we added back accounting amortization, we deducted tax CCA, and then we came up with the business income for tax purposes. So a partnership will have to do the same, and when they figure out what is the net business income for tax purposes, then they can use that amount to allocate to the individual partners. Now, a partnership could have other types of income as well. So for example, if a partnership has dividend income, when that dividend income gets distributed to the individual partners, it will retain the same characteristics. So then each individual partner will need to determine, was that dividend income eligible or non-eligible? And then on their individual tax return, they will report it as such. And then they'll be subject to the gross up and also the dividend tax credit. Same with capital gains and capital losses. So if a partnership earns, let's say, capital gains and capital losses, those will be allocated to the individual partners, once again, based on the partnership agreement. And then when each individual partner receives that amount, they will take 50% of that and include it in 3B when they calculate their net income for tax purposes. And there's also the same method for charitable and political donations that are made by the partnership. So if the partnership makes contributions to a charity or a political party, the partnership, because it does not file a tax return, does not get to deduct that amount. Once again, that donation amount will be allocated to each individual partner based on the partnership agreement. And then each individual partner can use that amount to determine the amount of their donation tax credit. So that's sort of a brief overview of partnerships. What I want to do next then is go to a really simple example. So let's just scroll and look at this simple example here. So let's say we have this partnership. We have partner 1 and partner 2. Now we're just going to focus on partner 2. And in this partnership, 60% of the income is allocated to partner 1 and 40% is allocated to partner 2. So let's say that partner 2 initially contributes $10,000 to the partnership. Just sort of think about a partnership just like a corporation. When a corporation is first formed, it must issue shares to the shareholders. So the shareholders will contribute money to the corporation in exchange for shares. Now with a partnership, the same thing happens. Each partner will contribute money to the partnership, money or other assets. And the partnership will track each partner's investment using what we call their capital account. So if partner 2 contributes $10,000 to the partnership then will record that in partner 2's capital account as an increase of $10,000. Think of that just as sort of the equity that the partnership has. Now, a partner also has to track what we call their partnership interest. Now, think about the partnership interest just like a shareholder would think of as their shares. They're going to contribute money to the partnership. Now, the partner can sell that interest down the road. And if they sell that interest down the road, then they're going to have to figure out, did they make a gain or loss on the sale of their partnership interest? So for tax purposes, the partner has to track the adjusted cost base of their partnership interest. So if partner 2 contributes $10,000 to the partnership, the adjusted cost base of the partnership interest will obviously increase by $10,000. So if they were to contribute the $10,000 to this partnership, let's say nothing else happens, and then partner 2 was to sell their partnership interest to a new partner, then to figure out their gain or loss, they would use $10,000 as their adjusted cost base. Now, let's just say that also during the year, partner 2 withdraws $5,000. So whenever there's a withdrawal from the partnership, for accounting purposes, that's going to decrease the accounting capital account. And for tax purposes, that's also going to decrease the adjusted cost base of the partnership interest because they took $5,000 out. So that's going to reduce the adjusted cost base by $5,000. Now, another thing that happens is the partnership is going to be generating business income during the year. So let's say that during the year, this partnership generates accounting net income of $100,000. And remember, partner number 2 gets 40% of that. So from an accounting perspective, $40,000 of that accounting net income will be allocated to partner number 2. Now, for accounting purposes, that $40,000 is going to increase their capital account. So for accounting purposes, at the end of the year, partner number 2's accounting capital account will be $45,000. That's what's going to show up on the partnership's balance sheet. Now, for tax purposes, remember we said that there could be some adjustments that are made to get from accounting net income to net business income for tax purposes. So let's just sort of go through a simple reconciliation here. Let's just say that this partnership started off with accounting net income of $100,000. That's based on the accounting rules. And then let's say included in that accounting net income, they deducted amortization expense of $20,000. Now, for tax purposes, we cannot deduct the amortization, so that has to be added back. However, for tax purposes, they get to deduct CCA. And once again, let's say that CCA was $40,000, just making up some numbers here. So therefore, for tax purposes, the net income for tax purposes is going to be $80,000. Now, once again, 40% of that goes to partner number 2. So for tax purposes, partner number 2 is going to include $32,000. So partner number 2, for tax purposes, will include $32,000 of business income in their net income for tax purposes calculation. So that amount would be included in 3A because that would be where business income gets included. Now, even though the partnership may not actually give that money to partner number 2, partner number 2 is going to be taxed on that amount on an accrual basis. So the partnership earns this income during the year. We figure out that partner number 2 is going to get $32,000 of that net income for tax purposes. And so partner number 2 has to include that on their tax return in the same year on an accrual basis, even though the partnership may not actually give that cash to partner number 2. Now, this is the amount that we use to adjust partner number 2's partnership interest adjusted cost base. So for tax purposes, to track the value of the partnership interest adjusted cost base, we would add the $32,000. We're using the tax amount. And so for tax purposes, partner number 2's partnership interest will have an adjusted cost base of $37,000. So if partner number 2, let's say, was after this year was over, if they decide to sell their partnership interest to a new partner, they would use this $37,000 as their adjusted cost base to determine whether they had a capital gain or loss on the sale of that partnership interest. So that's sort of a simple example, sort of tracking a partner's partnership interest, adjusted cost base, and also reconciling the partnership's accounting net income to net business income for tax purposes, and then figure out how much is allocated to each partner. What I want to do next then is go through an example or question that I want you to work on. So this is the question that I want you to work on. Your instructor may have given this to you ahead of time and you may have already worked through it. If you have, then just scroll directly to the solution. But if you haven't yet worked through this problem, pause the video, read through the problem, and then once you have your solution prepared, then resume the video to compare your solution to the answer. Now, there are two requirements here. The first requirement is to do that reconciliation. We're given some accounting net income amounts above, and we have to reconcile the accounting net income to net business income for tax purposes. And then we have to figure out that based on the partnership's income and losses and other amounts, how much will be allocated to each partner. So pause the video now, complete the requirements on your own, and then when you're ready, resume the video. Okay, let's have a look at the solution. So the first thing we have to do is to reconcile the accounting net income and determine net business income for tax purposes. So the starting point is going to be our accounting net income. So we're told that the partnership has accounting net income of $625,000. Now, most of these adjustments are fairly self-explanatory. Remember, meals and entertainment, only 50% is deductible for tax purposes, so we have to add back 50%. Now, the loss on the sale of the asset, the investment, it was noted in the question that this is a capital asset. So because this is a capital asset, and there was a loss on it, we have to separate that out. Here we're just trying to calculate the business income. So we have to take out that capital loss because it's treated differently for tax purposes. Now, in your textbook, it also says that any club dues and costs of recreational facilities are not deductible for tax purposes. So we have to add that back for tax purposes. Accounting amortization we're not allowed to deduct, so we add that back as well. And also charitable contributions. Remember, for tax purposes, charitable contributions for individuals are deducted or are treated as a tax credit. So they're not deductible for the calculation of net business income for tax purposes, so we have to add that back. However, we get to deduct CCA and also terminal losses. So this is the net business income for tax purposes. That's the first step. What we do next then is we have to allocate that to each partner, Rick and Kelsey, based on the terms of the partnership agreement. Now, when you look at the partnership agreement, you'll notice that there are some priority amounts. Those are those salary amounts. And so Rick gets an annual salary of $50,000 and Kelsey gets an annual salary of $25,000. So we take the $721,000, we minus the $50,000 and the $25,000, those are priority amounts, and the remaining $646,000 is going to be allocated 40% to Rick and 60% to Kelsey. So we work through those numbers, and then once we figure that out, of the net business income for tax purposes, $308,400 will go to Rick, and $412,600 will go to Kelsey. And if you add up those two amounts, that's going to give us the total $721,000. So that's how we allocated the net business income for tax purposes. These amounts will go into each of their calculations for net business income or net income for tax purposes in 3A. Now, we also have other types of income as well. There's also the capital loss. So the capital loss of $48,000, remember, only 50% of that's allowable for tax purposes. So there's going to be a total allowable capital loss of $24,000. And we're told that capital gains and losses are going to be split evenly. So each partner is going to get an allowable capital loss of $12,000. And they can use that in 3B to offset any taxable capital gains. Now, this is going to be based on each individual partner. Rick and Kelsey will include that $12,000 allowable capital loss separately. If they don't have sufficient taxable capital gains to use it up, then the unused amount will become a net capital loss carryover. Now, the final item is the charitable contribution. Now, the total charitable contribution was $23,000, and we're told that that's going to be shared evenly. So each partner is going to get $11,500. And once again, that's going to be used as a tax credit. So they can use that $11,500 to calculate their donation tax credit on their individual T1 tax return. So that brings us to the end of this question and also to the end of this video tutorial on partnerships. Good luck with your studies, and we'll see you in the next video tutorial.